If you're an investor or thinking about diving into the world of ETFs, you've probably come across the QQQ, QQQM, and QQQI. These ETFs track the Nasdaq-100 Index or a variation of it, but each one has unique features that might make it more or less suitable depending on your investment goals. In today's video, we're going to break down what each of these funds offers, their key differences, the pros and cons, and which one might be the best fit for your investment strategy. Whether you're a seasoned investor or just getting started, understanding these ETFs can help you make more informed decisions. Let's dive right in. Section 1. Introduction to ETFs and the Nasdaq-100. Before we dive into the specifics of each ETF, let's take a moment to discuss what ETFs are and why the Nasdaq-100 is such a big deal. ETFs, or exchange-traded funds, are investment funds that are traded on stock exchanges, much like individual stocks. The advantage of an ETF is that it provides you with a diversified portfolio of assets in a single investment. By holding an ETF, you own a slice of many different companies, which spreads out risk compared to investing in a single stock. Now, the Nasdaq-100 Index is particularly popular among investors because it represents the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. This index is heavily weighted towards the technology sector, with giants like Apple, Microsoft, Amazon, and Tesla at the forefront. If you believe in the long-term growth of the tech sector and want exposure to some of the most innovative companies in the world, the Nasdaq-100 is an attractive option. Section 2. QQQ Overview. Let's start with QQQ, the Invesco QQQ Trust. Launched back in 1999, QQQ is one of the oldest and most well-established ETFs on the market. It's designed to track the Nasdaq-100 Index, providing investors with exposure to 100 of the largest non-financial companies listed on Nasdaq. Why is QQQ so popular? For one, it's a high-liquidity ETF, meaning there are plenty of shares being traded every day. This makes it easier for investors to buy and sell without significantly affecting the price. It's also a favorite for short-term traders and options traders due to its high trading volume and market visibility. Pros: a high liquidity. As one of the most traded ETFs, QQQ offers tight bid-ask spreads, making it easy to enter and exit positions quickly. A strong track record. QQQ has been around for over 2 decades and has delivered strong returns, especially in bull markets dominated by tech. The extensive research coverage. Given its popularity, there's a wealth of research, analysis, and data available on QQQ, which can be useful for making informed decisions. Cons: a higher expense ratio. QQQ comes with a 0.2% expense ratio, which is higher than some newer ETFs that track the same index. A large fund size. With a massive amount of assets under management, the sheer size of QQQ can sometimes lead to increased volatility, especially during market corrections. QQQ is ideal for investors who want a straightforward, liquid, and well-known ETF with direct exposure to the Nasdaq-100. Section 3. QQQM Overview. Next up is QQQM, the Invesco Nasdaq-100 ETF, which was introduced in 2020. While QQQM might seem like just a smaller sibling of QQQ, it comes with some distinct advantages that can make it more appealing to certain types of investors. Like QQQ, QQQM also tracks the Nasdaq-100 Index, giving you the same exposure to those top 100 non-financial companies. However, it does so with a lower expense ratio of just 0.15%. Why choose QQQM over QQQ? The primary reason would be the lower cost. Over time, the lower expense ratio can lead to slightly higher net returns, especially if you're planning to hold the ETF for the long term. Pros: a lower expense ratio. With an expense ratio of 0.15%, QQQM is a more cost-effective option than QQQ, making it a better choice for buy-and-hold investors. The same exposure as QQQ, you're still getting the same companies and the same performance as you would with QQQ, but at a slightly lower cost. A smaller fund size. Being smaller in size, QQQM may appeal to investors who prefer a fund that can potentially be more nimble. Cons: a slightly lower liquidity. Although QQQM is growing in popularity, it doesn't yet match the liquidity of QQQ, which could result in slightly wider bid-ask spreads. In newer with less historical data, since it was only launched in 2020, QQQM doesn't have the same long track record as QQQ, which might be a consideration for those who value historical performance. QQQM is an excellent choice for long-term investors who want to minimize costs while still gaining full exposure to the Nasdaq-100. Section 4. QQQI Overview. Lastly, let's take a look at QQQI, the Invesco Nasdaq Next-Gen 100 ETF. This ETF is a bit different from QQQ and QQQM. Instead of tracking the top 100 companies in the Nasdaq, QQQI tracks the Nasdaq Next Generation 100 Index. This index includes the next 100 largest non-financial companies listed on Nasdaq that are not part of the Nasdaq 100. Essentially, you're investing in the future giants of the tech and growth sectors. Why consider QQQI? If you're looking for growth potential beyond the established tech giants, QQQI offers exposure to mid-cap companies that have the potential to grow into the next leaders of the Nasdaq 100. Pros: a growth potential. These mid-cap companies could see significant growth as they scale and potentially move into the Nasdaq 100 over time. Diversification. QQQI provides a way to diversify your portfolio beyond the large-cap tech companies that dominate the Nasdaq 100. A focus on innovation. Many of the companies in QQQI are at the forefront of emerging technologies, making this ETF attractive for those who want to invest in the next wave of innovation. Cons: a higher risk. Since QQQI includes smaller, less established companies, there's a higher risk involved, particularly in times of market volatility. A less liquidity. QQQI is newer and less traded compared to QQQ, so it might have wider bid-ask spreads and lower trading volumes, and not a direct substitute for QQQ or QQQM. If you're looking for a direct replacement for QQQ or QQQM, QQQI isn't it. It's a different type of exposure, focusing on smaller companies rather than the largest tech giants. QQQI could be a great fit for investors looking to capitalize on the growth potential of mid-cap companies that could become the next big names in the Nasdaq 100. Section 5. Which ETF is right for you? So, with all this information, which ETF should you choose? A QQQ is ideal if you want high liquidity, a proven track record, and direct exposure to the biggest tech companies. It's perfect for active traders and those who prioritize ease of trading. A QQQM is better suited for long-term investors who are looking to keep costs low while still getting the same exposure to the Nasdaq 100. It's a great option for those who are in it for the long haul and want to maximize their returns by minimizing expenses. A QQQI is the choice for investors with a higher risk tolerance who are looking for growth opportunities outside of the established giants. If you believe in the potential of the next generation of tech leaders and want to diversify into smaller cap stocks, QQQI could be the ETF for you. Remember, your choice should ultimately depend on your investment horizon, risk tolerance, and portfolio goals. Each of these ETFs has something unique to offer, so it's important to consider what aligns best with your financial strategy. And there you have it, a detailed comparison of QQQ, QQQM, and QQQI. Each of these ETFs offers different advantages depending on what you're looking for in an investment. Whether you're seeking liquidity, lower costs, or growth potential, one of these ETFs could be a great addition to your portfolio. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to the channel for more content on investing and personal finance. Let us know in the comments which ETF you're leaning towards, or if you have any questions. We'd love to hear your thoughts.